What a day, and you can see the huge rotation start to take off. I think the most important thing that we're seeing is the divergence between the two indexes. We're definitely getting leaders again, and that's super important, but this economic data is something we have to go through. The ES, we don't really need to spend a lot of time on. I mean, we can obviously see what happened here when we drill into this before we get into the details. And I do think it's important just to look at this. We always go back to that 830 level or 815 level when you have a piece of data. And you got a piece of data today at 815, and we're going to have to go through it, but you can see that level in here. And I'm doing this on a 5-minute. I'll do it this way so you can see it. You just see that range right here. And what we can do is just actually squeeze that to the true 5-minute. Then you watch that break and then watch it to the 5-minute orb on the way down. It's your entire range all day. That 5-minute hold, bounce, reject, hold. So you know where your range is. But what I think you're doing is I think you're rotating, and I think you're rotating for a reason. And I'll explain in some data in a second. But first, 27.5% of you that watch these videos do not subscribe. Hit the subscribe button, all notifications. What we go over here is extremely timely, and it's all linked together. Let's get to it. Now, what you have for one, you should have for another, correct? Yes and no. And I think that this is super important, what we're saying. Let's go to the 5-minute on the NQ and the NASDAQ, because when you spend some time here and you look at the difference, and there is a difference, there's a huge one. So here we are at that 815, and look what the level that you spent the majority of time at today. And you never really got to the low end of that orb on the trade. Where you got was here, and then you saw the low, and then it got tighter and tighter. Go take a look at the ES again and look at the difference. So what does this mean to us? It means that the NASDAQ's leading, which is really healthy. I use this spread. This spread helps me out a lot. I've been using this for years. And really what it is, it's the relative performance of the Qs relative to the SPY. And what it does is it just lets me know who's leading and who's not leading. You always want the NASDAQ to lead, unless of course you're short the market. But what is super important about this to me is the following. And we'll get into this in Saturday's video. But if you look at like March, April, this level down here, from when we bottomed, you'll see it right in here. From that stop all the way to here, when he said tariff on, tariff off, they're paused. From there, what transpired? And this is, again, super important. That level, do we get some kind of breakout where they're rushing into the NASDAQ? I actually think that you might, and I think it might be tied into some of the stuff that we're seeing here with the economic data, and I'll explain it in a second. But if we take a look at this, yeah, one of the key demographics that I use, maybe I can just do it this way and save time. Yep. Once we flip above the 55 here, it's pretty much on. And you can see that for yourselves. But we're not really breaking out yet from this relative performance. I use relative performance of things a lot. Why? It tells me where to put my money. It makes my life very, very easy. Who's outperforming? Let me go and do that. I don't need to tell it what it's going to do. You tell me what you're going to do, and then I'll go put my money there. But if you look from 23 on, you had this trough valuation. Now, what's cool about this is that was the rally right into it. So that becomes that level of now support that we've hit for years. And now you're getting these highs. But if we start breaking out where the relative performance of the NASDAQ over the SPY, that's exactly what you want out of a market. Because you want that high beta, you want that alpha, you want them chasing that. But we had some things here that were of concern today with the employment data, and I think we should go over that before we go any further. We had some real developments today, especially in the ADP employment change, so I think it's important to spend some time on this because it's something that people have been concerned about, and we're finally seeing cracks. Now, this ADP employment change, just so we're clear about this, ADP only uses ADP data. Average client average about 30 employees. But what we saw today was the actual came in at 37,000. Previously, we were looking for 60. The hope was that you would come in at least above the 60. The consensus was 115. You came in at a third. You literally came in at like 1/3 of that consensus, which is kind of crazy. We're going to get to this in a second. ISM PMI dropped below 50. That's not great. It takes a lot to move these things. But if we start losing the services PMI, and just so we're clear, 50 is the even line. 51 or above, or I'm sorry, 50 or above is expansion. 55 means you're hot. 45 means you're cold, and usually signs where you're going to start cutting. The real issue is this ADP. I think it's just important to take a sec just to go through this. We have to spend a lot of time on it, but we have to spend some time on it. If you take a look at the ADP data, and what it's telling you is just the net employment change across their billing. In other words, when they do payroll. And you look from here over, this really is the lowest that you've been in 12 months. And what we've seen is, we saw this exuberance where you were coming in to the year, all of a sudden, yay, things are going to get better. And then we started seeing, okay, tariffs, and then they kind of went away, and then we all got liberated, and now this is where we're at. And I think that this is really important to get. We started off like super excited, but this data, we're waiting for this turnaround, and we're just not getting it. And I think that this is super important to get, because when people always look and say, what could derail us? Like, what could be the thing that derails us? Employment could derail you. Remember, everything is macro, fundamental, technical. We always go by the stool. And right now, what you're saying, I'm not going to make this too bad. Oh, there we go. We'll make that like a double stool. So what you're seeing here is this is pretty bad. If actually, you know what? Let's take a look at a 3 year. Now, this should put it in perspective. So if we look at their billing cycle, and we came across, and I did zoom in on this before I did it and showed it. These two were higher. These were in the 40s, both here. And the only one that really missed was here. So this is pretty much the lowest besides this in 3 years. And to me, that's telling us something. And you're seeing this kind of shift in it. This really, we don't really want to see this get negative, because then it gets into contraction. And if we watch employment go up or unemployment go up, and that number starts getting on a percentage basis like a 4 or 5 or something like that, or a 4 on unemployment, it's going to be a problem for equities. Now, we get more data tomorrow, and this is leading up to Friday, which we have to go over. But there's some things here that people tend to miss. So Challengers, they are a headhunting firm. They do, obviously, the job cuts. They show their job cuts. And that's at 7:30 in the morning. Nobody really pays attention to this. You might want to watch this number tomorrow. What we're hoping is that what's going on is this. We're hoping that what you're seeing is an increase in holding people at their job, and just a decrease in new openings. That's what we're hoping that we're saying. I'm not so sure that's the case. And one of the other things that people are going to start watching weekly, and when I started trading, this was everything that we watched. We always watched the initial claims. Claims were everything. This is when, when I started in like the mid 90s, this is what we watched. And what you were doing is just watching, if this goes up or down, it tells you if you have a consumer or you don't. But this slow creep up, which it's doing, is something that I'm paying attention to. We were always in the low 2s. Now we're in like the mid 2s. And then you get to the consensus. But we'll get there. But you see this continuing jobless claims? This is the people that all of a sudden they can't get a job, or they're still on the claims. This is really important. Nobody's really talking about it. We're going to spend a sec on it because we have to talk about Friday. But this initial jobless claims of 240, 235, we don't want to start seeing like 280, 300. Like we don't want to see that, because that's going to lead to the unemployment number. And then all of a sudden, if we get an unemployment number like that, you're going to get that percentage. That's going to be a problem for us. That 4.4, 4.5, 4.6. You don't want them cutting rates because things are bad. You want them cutting rates because of increased productivity, and them trying to spur some kind of demand in the buying because because the productivity is so high. It's nuanced, but it's like that. It was like that in the late 90s, and that's really what you're looking for. And just to throw this out there super quick, this is continuing claims. This is 3 years. Nobody's talking about this. And we are saying, oh, well, we're not really seeing signs of a weakening economy. Man, that's drawn god awful, isn't it? Let's draw that a little bit better. But no one's seeing signs of a weakening economy. Well, we're talking about this. We're talking about these delinquencies going up. And look at continuing claims. They're at 3-year highs. So yeah, we are seeing some signs of it. It's nuanced, but it's there. And I think we have to pay attention to it. If you're looking at this, it's not dropping. And again, you've seen since 23, what's happening? You're getting continuing claims. Now, that's going to lead us right into this. Non-farm payrolls, 8:30 on Friday. Previous was 177. Here's the actual, obviously, which we have to see at 8:30. And this could jolt the market. Consensus is 130. 177. This is where it gets super interesting. The unemployment rate is at 4.2. Does that unemployment rate start ticking up to 4.3? Do we start to see some kind of rise there? Average hourly earnings month over month. You might see an increase here because you saw it personal income. So it's kind of hard to imagine personal income going up and average hourly earnings month over month not going on. The participation rate and the average work week are usually what they are. But when you look at the ADP data, that really locks in with this private payrolls. Now, private payrolls here is based upon BLS, and BLS is not just 30 companies like ADP. ADP, which we would say in here, the average is 30 companies. This is everybody from GE to those 30 companies. Previously, payroll private side, you came in hot. You came in at 167. You're looking for 120 this time. Manufacturing is looking for a negative number. I'm not so sure that it'll be negative. I think you might see some ramping up there, maybe. with people thinking about the tariffs and hiring here. But government jobs, we were told about this massive layoff, and previously you saw 10,000 more people hired at the government. We have no consensus breakdown there. So not only do we want to watch this number Friday at 8:30, because this will be the big mover. This day is a big day for us, especially with what we saw come out today. And we also just want to see how they're going to fill in these boxes. Let's get to some charts. Now, the good thing is the economic chaos and economic uncertainty, what it's doing is a couple things for us. It's creating buying opportunities, or as you could say, selling opportunities or trading opportunities. But I'm looking at it as buying opportunities. And I'll give you an example of this. One of the key things I note is how things trade relative to how they traded before. One thing that I note a lot of is relativism. So how did something trade as it traded before? Are we seeing a changing trend? And one thing that I will note is that if you look at NVDA back here, seasonally, May has been a strong quarter in the past, but you really can't go back to 23 because this is when it really just started, right? We see May 23 and you ripped, and then you have May 24 and you ripped, and you have May 25. I think you have to go quarter by quarter, but you can look at the seasonality as well. But when you look at NVIDIA here, for example, last quarter you sold straight down. This quarter, straight down. So expectations, it didn't meet them, straight down. And then all of a sudden, we changed. And now we're back to this deep seek level. And all before AVGO tomorrow night. And if you don't know, now you know, AVGO is tomorrow night. And it's pretty much going to be the cat's pajamas. It is pretty much going to be the one that everybody's watching. Now, the big issue you have to ask yourself, and I'll go off on this one very quick tangent, and every trader needs to ask themselves this. You are at a level from here where you are Thursday, right, March 6th, where you had the last earnings. Now remember, you got a lot of liberation in here, but from here to here, you're up decently on this trade. You're up 35% from earnings. So it's a big move. So there's a lot of people that are expecting this, but you're at the same level you were in December. So did you really move that much since December? Not really. And I think that there's a couple different ways to look at this. So let's keep that in mind. But you have come very far, very fast from 138 to 261. I mean, you have a double if you bought the bottom. We bought from the swing in here. If you're in the community, you already know that. And I'm still in the thing. So it acts great. But the point being is the volatility is presenting huge opportunity. And the opportunity here for me is also based upon the VIX, which is kind of fascinating because what's happening is options are priced so cheap to buy protection. If you're a seller of options now, you're getting killed. You can't figure out why. It's because the VIX is at 17 and the implied vol is just imploding. But if you're a buyer of options for protection, which is one of the reasons why options were actually created, you can actually do really well right now. So I'll show you what I mean by this. So this is something that I've been building a position in now since earnings, trying to build it up for AVGO. If AVGO is down and, or why AVGO comes out with earnings if it goes down, but I want a huge NVIDIA position. But one of the things that I'm doing with it is when it does these dips, I'm just buying stock against puts. So when it drops today and we're watching it drop, I'm not shorting it. I don't have to do that. I'm just buying puts and then I'm buying stock against the puts. So I'm actually locking a portion of the profit in on the put and then behind it, I'm just buying stock. So if I'm buying stock here and then it goes up and then the puts here, first off, you can cap what you're going to lose. But between what you lock in by buying down here and then where it is, my risk is like $1 in that trade, just off of that one. And if you keep doing it over and over again, you're able to build this fairly decent sized position. I did it here as well. You can build this fairly large position for very little risk. And then if it works, and I can get 144 or 145 or something like that on this, you can do exceptionally well. And so I really stress that you look at trading this kind of stuff right now. Here, I'll give you a live example. Let this fall apart. Come back down. Let's say this breaks. I can buy NVIDIA 140 for $1.30. I'll go out there and I just bought like a bunch of puts. And then what I'll do is I'll leave them on. And then if I get down to here, like 140, I just put an offer to buy stock. And then that just lets me hold the stock at 140 for the next 3 days into AVGO's earnings. I'm taking the risk that it doesn't break down, but if it does break down, and if it doesn't, I'll just close the puts and lose like 10 cents. But let's say AVGO crushes. Well, then NVIDIA could be worth 148, 144, and I own all this stock for $1 of risk. So it's like 3 to 1, 4 to 1. All I'm letting it do is drop. I'm trying to get under 140 on stock. And if it does, I'm just going to buy stock against it. Instead of shorting it, playing around with it, I'm just leaving it there and I'm trying to see if I'm going to get it cheaper or not. I could sell those puts and lock in 30%, but that's not really what I'm trying to do. I can put a buy stop at like 140, or I could just play the game and let it keep dropping and see if I can make even more money off the put and then just marry the stock even cheaper. Those options are $2 now. So I made a little extra money off those puts by buying the stock. 25 cents, 30 cents by the time I'm said and done. So I just want to be clear about this. This is what you should be focused on all the time. If you can't quantify your risk on a trade, you don't have a trade, you have a dream. So I can't stress this enough. Someone sent me a video the other day and I was in tears. I was laughing so hard. I actually thought it was parody. Like one guy was showing how you just trade this opening system and he just does the same kind of trade every hour, every day, and that's all he has to do. I actually thought it was a parody. This is extremely hard what you're trying to do if you're learning this right now. What you're doing with every position, every single one, you have to monitor your risk. When the market offers you an opportunity cheaply to protect your downside, you need to take advantage of it, right? This is really hard. And people act like this is super easy to learn and super easy to do. It's not. It's not easy. And so that alone, I think, dispels a lot of people. And I think it makes it hard for people when they're like, well, this guy's saying it's super easy. He trades 90 minutes a day and makes millions. No, he doesn't. No, trust me, he doesn't. It's super, super hard. You're playing against the most disciplined and smartest people in the world. So when you're given an edge, like you were given today and how you're being given an edge with put protection, or even if you're playing calls right now, you're probably doing very well. It's not you. You didn't get better. Maybe you did. Maybe I shouldn't be that mean. But like the VIX is at 17, guys. And I want to finally just wrap this up. You're starting to see a rotation. And I personally think it's tied to a couple things. So JP Morgan upgraded a couple names today. Let's go through them. And you're going to start seeing a theme here. I'm just going to show you where I think we're going with this. As the unemployment either upticks or goes sideways, employment cutting AI, either way, whether it becomes a tariff issue or not, you're starting to see all these app companies starting to do exceptionally well. And you're seeing it everywhere. So Meta, just disclosure, this is something that I own. You're seeing this breakout, these 3-bar patterns. You have one bar here, here's the second, and then boom. You just don't want the second, you want the second bar to be less than 50%. I'm gonna do a video on pattern recognition. But when I see this, like I saw it this morning, I'm like, oh, it's gonna flip. And once it flips those, that's exactly exactly what you want to see. What I really liked about this is even though it's not over at like huge volume, it's still over all my scans. So it did trigger from that side, and I can also look at it on a smaller time frame. The thing about the smaller time frames is I want to see it more than just, here. I want to just not just see it the first bar. I want to see the second and the third. Also, just FYI, to give yourself a little bit of advice here, you don't have to wait 15 minutes. Or you don't have to, like if it gaps like this, if you're ever trading and I know I'm giving a bunch of like little nuggets, but I'm going to give you this one because this one thing can save you a lot of ag. This one thing can make you a lot of money off a 5-minute orb trade. If you're watching this on a 5-minute bar, and then the next 5-minute bar has huge volume that's bigger than the first 5-minute bar, chances are it's probably going to continue to push because they couldn't buy enough on this one, so they moved to that one. And you can drill into that by lowering your time frame. And you can start to see them do that, whether you're using a 3 or whether you're going to use a 1 to do it. You'll start to see those bars just start spiking. You don't have to wait for the 5 to do that. But if you start to see that, where the next bar is greater than the opening bar, you're on to something there. So just keep that in mind. But with this kind of stuff moving like Meta today, you're seeing JP Morgan come out, pound the table on Meta, basically putting the target back above all-time highs. They're coming out, they're talking about Spotify being the cat's pajamas, and that's why that moved 25 points today. But you're seeing it even in the names that they didn't talk about. You're seeing it in Netflix today and how Netflix is at all-time highs. Disclosure, I own those names. But here, take a look at this. There's more. Take a look at this. So you're seeing things like Dash breaking out today. Look at the volume. It's not great, but you're seeing that follow through. I would focus on the ones where the volume's going through. The other thing that I would say is a lot of these smaller names that have to do with aerospace, bigger names and smaller names, but all this aerospace stuff's getting tons and tons of attention. And I wouldn't sleep on that. But the big dog that you really have to watch tomorrow night that's really going to change things is going to be the AVGO. And I just want to point this out to everybody. And we've obviously been watching this and talking about it, but you have a channel here. And this channel's setting up to break out, in my opinion. But you're really going to have to see what happens with the earnings. You popped out of it. You always want to clone these. But you popped out of it and you popped right back in it. So the question is, am I just getting an enantiomer from here to here? Or am I actually going to push? I think it's in AVGO's hands. And the question really is, are people going to look at this and how much do they have to beat? What do they have to say? This was one quarter and you're back in line with where you were in December, but you are up 35% from March. So a little bit of a pickle, but I'm looking forward to it tomorrow night. That's it.